It's not about picking stocks. It's about picking the right portfolio.
The first one here is a look at accumulated excess savings relative to pre-pandemic levels. So, and importantly, by income cohort. So at the top left there, what you see is the total savings of all workers who are in the lowest quintile of earnings annually. So they went into the pandemic with 50 billion in accumulated savings. You got up as high as about 54, 55 billion, and that's come down since pretty steadily. And as of the latest reading, 1Q23 is now at a level not insignificantly lower than where it was actually pre-pandemic. So this is really the sort of negative real wage growth that we've seen going on now for, I think it's 26 consecutive months, might be even longer than that. So certainly a heavy toll being taken there. If we move to the top right and we look at the next income quintile up, so the 20th to 40th percentile, we see a similar dynamic. So pre-pandemic, their accumulated savings were 68.6 billion. That number has since been drawn down to 62.4 billion. I should point out these numbers are inflation adjusted. So this is your real purchasing power of your savings. But the point is, they've been drawn down significantly from 68.6 down to about 62.4 as of Q1. And then if we look at the aggregate of the first, second, and third income quintiles, so now the 0 to 60th percentile, what we find is that in the aggregate, that cohort, the bottom 3/5 of earners across the country are back to where they were pre-pandemic, or actually below that now. So all those excess savings that had been accumulated during the 2020-2021 timeframe have been spent, and the trend continues to be that of moving lower. So obviously, that's really the area of the economy that is getting squeezed the hardest from an excess savings standpoint. What's notable is that the resilience of the labor market, at least thus far, is what's helping to sort of offset these charts. In other words, so the bad news is that savings have been drawn down from purchasing power standpoint. The good news is that the labor market has remained resilient. We expect when the labor market does worsen at an accelerating rate, you're going to have the sort of collision of these two dynamics. So you're going to have worsening labor market dynamics combined with significant drawdown in savings. So those two things are not going to be good when they collide.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.